Welcome to the CashStream Financials video, An Introduction to Debtor Finance Part 2. My name is Tim Lee, and I'm the CEO and founder of CashStream Financial, specialists in raising cash flow finance. You might be interested to know this video is part of a series of videos related to commercial finance which are available to view in the Learning Centre of our website, cashstream.com.au. In almost 20 years' involvement within the debtor finance industry, I have seen the facility work incredibly well. In the screen in front of you, there are a number of signs that are so typical of a company that could benefit from debtor finance. You might just want to pause the video for a moment to see if any of the enclosed comments reflect your business. If they do, and your business is suitable, you should at the very least consider debtor finance as an option. There are many misconceptions of debtor finance, and in the screen you can see a number of the key ones here. The first major one that we hear regularly is that debtor financiers give you 80% of the invoice and keep the rest. This is far from the truth. The truth is more likely that you'll pay between 0.15% to 2.5% against an invoice value, plus the cost of the funds that you borrow, which clearly you're in control of. Secondly, a number of people consider that debtor finance is just factoring. Worldwide, the marketplace has recognized that people do not necessarily need their customers to be aware of the finance company's involvement. As a result, there are many facilities that are confidential. The third misconception is that the facility is for companies that are going bust. In general business life, there are as many companies going bust on the way up as there are on the way down. If your business is expanding, the facility is ideal as the finance grows directly with your sales. If your company is failing, however, the additional cash will only put off the inevitable if you use the monies unwisely. In general terms, lenders do not want to get involved with failing companies as they have to crystallize their own security, which presents marked risks for them. Finally, many people have suggested over the years, if my customers know I use debtor finance, they will choose another supplier. In reality, the dealings between the debtor finance company and your customer will usually be at the purchase ledger side of the business. Equally, what other way of saying that you are growing and being successful than a finance company saying they are supporting you? So let's consider whether your company is suitable for debtor finance. If you remember one thing from this video, it would be this. Any company whose product or service is buy, sell, forget is appropriate for debtor finance. So for example, take a simple product, the coffee cup on your desk. It's very simple to manufacture and very few go wrong. Sure, the handle might come flying off, but in general terms the cups will be brought in from the supplier, sold and forgotten about. If you take the other extreme, however, for example the construction sector, where companies have complex contracts with staged payments, interim valuation, liquidated damages and a potential dispute around every corner, it's all very messy. In other words, it's not buy, sell, forget. You might want to have a look at one of our other videos, Industry Studies for Debtor Finance, where we look in more depth at the printing industry, the recruitment industry, and importers. Unfortunately, not all companies are suitable for debtor finance. Remember I mentioned earlier buy, sell, forget? Well, on the screen in front of you, there are a number of companies whose services are not buy, sell, forget. For example, we've mentioned about construction. When you look at professional services, for example, accountants, where interim billing is a regular issue, for management consultants the same, computer software where there are staged payments, large ticket manufacturers where there are staged payments. There are some players in the marketplace who do have offerings for these difficult sectors, but the level of finance is usually significantly reduced, the cost can be higher, and additional security may be required. If you have any queries on that side, please don't hesitate to contact one of our specialist debtor finance advisors at cashstream.com.au or call 1300 79 30 60, and one of our specialist advisors will be able to help. In relation to cost, the costs of the facility are generally more expensive than traditional bank overdraft. But the key benefit is you get access to more cash than a bank would feel comfortable giving you. For example, banks might look towards funding a business at 30 to 50% against the debtor book if they will consider it at all. Whereas a debtor financier, because they're specialists, can advance up to 90% against invoices. The costs in general are usually expressed as a percentage of turnover, usually of the range 0.15% to 2.5% of invoice value. In a number of cases, a fixed annual management fee can be negotiated. Plus then you have the cost of the funds that you borrow, which are normally expressed in an annual percentage. Now clearly you're in control of those costs in terms of you only pay for what you use. And these costs are usually in line with overdraft facilities not secured by property. In general terms, the costs of the facility are dependent upon the facility chosen, the risks, and the turnover. We hope you found this video useful, and any feedback is always gratefully received. I've been working within the debtor finance industry for almost 20 years, and I do declare I have a vested interest in the market. But I have to say I have seen the facility work incredibly well. If you wish to discuss any areas within the video or need assistance in assessing your options in this market, please do not hesitate to get in touch.